Welcome to my mini lecture on financial analysis. And before we get started, I wanted to give you a resource. So in the future, if you're away from college and you don't have access to your textbook and you come across any kind of financial, accounting, or economic term that you've had in the past but you can't quite remember, you can always Google it, and a lot of times you might see a good resource on the internet. Here we have a Wikipedia entry for financial analysis. This is very short, just a couple of paragraphs, but it does give you a lot of different methods and the goals of performing financial analysis and some of the tools that we use. So just for the future reference, that's a real good place to review information. We're going to talk about financial analysis, and in general, when we're performing a financial analysis, we're comparing data to something. In this case, we've got two types of comparisons that we can make, and we're going to try and derive information out of data. You all have had a lot of classwork and class time that you've spent on learning how to analyze financial transactions, make the decision of whether it needs to be recorded in the books, and then after you've recorded your journal entries, created trial balances, you've learned how to create generally accepted accounting principle financial statements. Well, the next step is people are going to use those financial statements, the data that you provided, to produce meaningful information for them. Who is going to need useful information out of a financial statement? Well, stakeholders. It could be some people within the company, like managers, or it could be people outside of the company, like bankers who are lending the company money. Or it could be Wall Street analysts, if the company is a public company and they want to analyze this company and compare it to other companies. But we have a couple of different types of comparisons that we can make. We can compare the data within a company by performing intra-company analysis. And the word intra-company, I like to think of comparing to an intra-state highway. Like here in New Mexico, we have Highway 14, which runs between Albuquerque and Santa Fe. It's wholly contained within the borders of New Mexico. That's an intra-state highway. Inter-company analysis is analyzing a company or comparing a company to other companies, different companies. Think of an interstate highway that isn't only within New Mexico, like US Highway 40, but it connects New Mexico to Texas and then going out the other side to Arizona. Also, when we do an intercompany analysis, we can use industry averages. Rather than just comparing to one company, we can compare to a group of companies if we have the information. So in looking at the financial statement analysis, we have some basic tools that we're going to learn about today: horizontal analysis, vertical analysis, and then ratio analysis. We can use any combination of these as long as it's providing information for us. And financial analysis never gives you a hard and fast answer. I like to think of it as just a place to start your investigation only. It gives you a little bit of information, and now you know where you want to go and dig further and deeper. And you can use any combination of these analysis in order to derive information out of financial statements. So the first thing we'll look at is horizontal analysis. I've got a formula up here, which you've got in the books as well. And we're taking the current year amount less the base year amount divided by the base year, and that gives us our percentage change. Let's take a look at an example of a financial statement, and this is Lilly & Company, their balance sheets for the period December 31st, 2007 and 2006. And we're analyzing the data here in yellow in 2007, comparing that to the base year in 2006. I only have 2 years up here, but there's no reason why I couldn't have done 5 years. In any case, we have to define a base year because we're going to express all of the percentage changes as a percentage of the base year. So in the case of cash, where I have a $100,000 increase, I'm telling you that's a 25% increase over the base year. I could have computed that 100% of $500,000 and said that was a 20% increase. Either one is a fair statistic, but I have to disclose. And what's important is that when we're quoting information, like we're saying sales went up or sales went down by a certain percentage, we're very clear of what the base year is. So by doing this, looking at the balance sheet, we get little bits of information that we had a 25% increase in cash, for example, and our current liabilities went down by 58%. Maybe we used some of the cash to pay off some of the liabilities, and that's a possibility. It's certainly one place that we could start performing further and deeper analysis. Here's an example of using the horizontal analysis on an income statement. You see where, again, I had a $500,000 in sales in 2007 compared to $400,000 in 2006. It's a $100,000 increase. That's a 25% increase based on the base year of 2006. So I'm analyzing the 2007 data and using 2006 as a base year. Let me give you another example of how a company can use a horizontal analysis, and this is looking at the detail of an income statement. So I'm only looking at expenses here, and if I was only looking in total at the expenses, you see that my 2007 expenses are $117,000, whereas my 2006 expenses were $116,000. $1,500 increase, 1% increase. That makes sense. But if we go a little bit further into the information, a little bit further into the data, I see that, okay, well, my rent increased by $10,000. Look here at utilities. Doesn't look like I have any utilities recorded, and last year I had $20,000. So since we're pretty sure that we needed utilities this year, looks like I didn't record this. So by using a horizontal analysis on a detailed financial statement, like this expense statement here, I'm able to see that I've probably made an error and I haven't included my utilities expense for the period. Next thing we're going to talk about after horizontal analysis is vertical analysis. And vertical analysis allows us not to look across years, but to look within a single year. So in vertical analysis, when we're talking about expressing something as a base amount, we're only looking within that one financial statement. So again, let's look at a balance sheet where we're going to do a vertical analysis. And here's Lilly & Company for 2007. And we're going to compare each line item on the balance sheet. All assets, all liabilities, all stockholders' equity items. And we're going to use total assets as our base amount. So cash is 38% of the base amount. Accounts receivable is 15% of the base amount. By doing this, we can compare within years of Lilly & Company and see flux changes, but that's very similar to doing a horizontal analysis. By expressing everything as a percentage, we can now compare it to other companies. So here I've got Lilly & Company, which has $1.3 million in assets, and I'm going to compare it to Jack Joe Company, which has $1.5 billion in assets. You might say these companies are totally uncomparable, but if they're in the same industry, I may get some information by comparing the two. So even though Jack Joe is much larger than Lilly & Company, everything is expressed as a percentage, so it's comparable. And I see that Lilly Company has 38% assets or cash to total assets, where Jack Joe is a little bit less. And I also see that current assets are 81% for Jack Joe Company compared to 55% for Lilly Company. This just gives me a little bit of information that I can use to start delving a little bit further. You know, why does Lilly Company, who's in the same industry, have a lower amount of current assets? Why do they have more invested in property, plant, and equipment? Just one place to start looking at information. I can also do the same thing on the income statement. Except on the income statement, I'm using net sales as the base amount for all of the different items on the income statement. So cost of goods sold, gross profit, everything is expressed as a percentage of net sales. And again, I've common sized this financial statement for Lilly & Company, and now I can compare it to Jack Joe Company, which is much, much larger. But by looking at them, I see that Lilly Company, their cost of goods sold is less. Why? Why is that? I need to start delving in a little bit deeper, and I can get maybe some useful information out of this. I also see here that Lilly & Company pays 15% in taxes, Jack Joe & Company pays 1%. Why is that? Again, it's a place to start our investigation. So vertical analysis, by expressing items on the financial statement as a percentage, they're common sized, we can compare them to other companies and other industries. So that's it for the financial statement analysis. Get your homework done, and look forward to seeing you in class.